Hello, and welcome to this channel. It's me. Thank you so much for being here. In this video, I will share some very important news with you. I want to discuss cross-border data, exchange, and the global tax web. This is something that you may have never heard of before, but it's critical to understand because it has significant implications not just for your taxes, but also for your financial privacy and freedom. Before we begin, please make sure that you subscribe to my channels, like this video, and share it with those who may be interested in this topic. Give me a thumbs up if you are ready to dive in. Now, what is happening is that tax authorities around the world have developed a system that allows them to exchange information about your transactions. This means that if you buy Bitcoin in one country and then move it to another country, the tax office in the first country where you purchased it can actually see that transaction and notify the tax office in the second country where you moved it to, and vice versa. The tax office in the country where you moved it to will see that and flag it to the tax office in the country where it originated from. So effectively, your trade or your movement of digital assets across borders is visible to multiple tax offices at the same time. The Common Reporting Standard, CRS, is an initiative launched by the OECD, which stands for Organization for Economic Cooperation and Development. This organization was founded in 1961 and it currently has 38 member countries. Their stated mission is to help governments tackle global problems. The OECD was initially created after World War II to help rebuild economies. But today, its work goes beyond just economic issues. Here is the problem. You may disagree with some of the policies or positions that the OECD promotes. Yet, many countries automatically adopt these recommendations without any public debate or referendum. In fact, most people don't even know that such an organization exists. The point that I am trying to make here is that there is absolutely no oversight or checks and balances to ensure that the OECD acts in the best interest of its member countries and citizens. And that is a huge red flag. So let's get back to the CRS. Under the CRS, countries agree to collect and exchange information about their residents, financial accounts held in other participating jurisdictions. As you can see here, over 110 jurisdictions participate in the CRS, including the United States, Canada, Australia, Brazil, China, India, Israel, Mexico, South Africa, and many European countries. And yes, Switzerland is on the list as well. Originally, the CRS focused on bank accounts and other types of financial assets. But now it's being expanded to digital assets as well, and let me show you how this works. When you open a bank account in a foreign country, that country's tax office usually sends your information to the tax office in your home country. Your home tax office then uses this information to determine whether or not you need to pay taxes on that income in your home country. This sharing of information helps to prevent tax evasion and money laundering. Now imagine you decide to buy Bitcoin. The process is similar. The only difference is that, instead of a bank account, you have a digital wallet with cryptocurrency. Now, the key thing to understand is that each digital wallet address is public and all transactions that go through that wallet are also public. So when you make a purchase of Bitcoin, for example, this information is immediately available to anyone who wants to access it, including government agencies. Once this data is out there, it can be easily shared between countries, especially if those countries are part of the CRS network. Let me give you an example. Let's say you live in the United States and you use a popular platform to buy Bitcoin. If the IRS considers Bitcoin to be property for tax purposes, which it does, then your capital gains will be taxed at your income tax rate. But what if you could avoid that? What if you could simply move your Bitcoin to a wallet in a country that does not tax cryptocurrency gains? Such as in some parts of Asia or Europe. Sounds too good to be true. Well, it is. As the IRS explains, U.S. persons are required to include on their federal income tax return all foreign financial accounts on which they hold a financial interest that are not reported on any previously filed U.S. federal income tax return. And that's exactly what happened to a U.S. citizen. He opened a bank account in Singapore and failed to report it to the IRS. As a result, he was convicted of a crime. Now consider this. Cryptocurrency transactions are recorded on the blockchain, a public ledger that anyone can access. So once the IRS gets its hands on your data, do you think it can be hidden? The answer is no. If you feel uncomfortable with the idea of the IRS tracking your cryptocurrency transactions, you may be wondering if moving to another country would solve this problem. Unfortunately, the answer is no, not really. Thanks to technology, tax authorities around the world can now track cryptocurrency transactions across borders. One way they do this is by using a tool called Chainalysis. This software helps law enforcement agencies trace the flow of funds in cryptocurrency. For example, if you move your Bitcoin from one wallet to another, the transaction is picked up by Chainalysis and it is flagged. This allows the tax office to see your digital assets in real time. According to Bloomberg, Chainalysis is already being used by the IRS, the Justice Department, and the Treasury Department. The company has also partnered with the French Tax Authority, the British agency responsible for economic crime, and the Australian government's tax office. The point that I am trying to make here is that if you try to move your assets to another jurisdiction to hide them from the IRS, you will likely be caught. And the odds of you being caught are high because of another program called the Global Tax Web. The Global Tax Web is a system that allows tax authorities around the world to share information about taxpayers. This includes information about bank accounts, investments, and yes, cryptocurrency wallets. To put it simply, if you move your cryptocurrency to another country, the tax office in that country will likely share that information with the tax office in your home country. As a result, your home tax office will be able to track your digital assets and potentially impose penalties if you do not report them properly. So what does this mean for you? First, it means that you cannot hide your cryptocurrency transactions from the tax office. If you make a profit from trading Bitcoin, you will have to pay taxes on it, period. Second, it means that you cannot avoid taxes by moving to another country. If you move to another country, the tax office in that country will likely share your information with the tax office in your home country. And third, it means that you should keep accurate records of your cryptocurrency transactions. If you don't keep accurate records, you will not be able to defend yourself against the IRS if it comes knocking. It's important to note that not all countries have adopted the CRS yet. But the number of participating countries is growing every year. So even if you move to a country that doesn't currently participate in the CRS, that may change in the future. If you want to learn more about taxes and how to legally reduce them, check out my other videos. Thank you for watching this video. I hope that it was helpful and that you enjoyed it. If you did, give it a like and show your support. Share it with those who may find it interesting and follow me on social media. I would love to have you back for my next one. And if you enjoy reading, check out my newsletter available online. I will see you in my new one tomorrow. Take care.